Welcome back to Investing Talk Podcast. Today, we're looking into Tecogen. And the really crucial question, the one we keep hearing, is pretty simple. Is Tecogen a good time to buy right now? We've gathered up the analyst reports, the latest news, financial data you shared, and we're going to try and synthesize a clear picture. Risks versus that, well, pretty substantial upside potential they're talking about. Before we really get started, if you enjoy this kind of discussion, find it useful, please do subscribe, like, and maybe drop a comment. And hey, if there's another company you want us to examine like this, definitely let us know in the comments below. We always appreciate your suggestions. Okay, let's jump in. Initial snapshot, Tecogen, they're in the distributed energy space. What immediately jumps out from the sources is this, well, contradiction. You've got overwhelming analyst optimism, strong by consensus rating, actually. But then you look at the history, negative earnings, operational losses. Makes you wonder. So we need to figure out what's justifying that bullish view, especially with the stock being, well, pretty volatile around its current price. What is it, $8.92 as of mid-October?
Yeah, that tension is really the heart of it, isn't it? It seems the market's looking past the historical performance. It's betting heavily on a future shaped by, well, three really specific transformative changes that all sort of came together in 2025.
Okay, catalysts. But before we dive into those, maybe some context. Tecogen isn't just like a standard utility company, right?
Yeah.
What's their core business? Why does their niche matter here?
Right. They're a leader, but in a very specific niche. The U.S. distributed energy market, specifically combined heat and power CHP, you might hear it called cogeneration. Basically, they provide these proprietary systems, mostly for places like large commercial buildings, hospitals, schools, food processors, allowing them to generate their own electricity on site. And crucially, they capture and use the waste heat that's produced for, heating or cooling needs.
Got it. So efficiency experts, on-site power. That tech base helps understand the pivot everyone's talking about, because there's been this huge positive momentum shift in the last, 3 to 6 months. What was the first piece to fall into place for this turnaround?
Well, the first move was really strategic. It was about raising their profile, accessing different kinds of capital. So back in May 2025, Tecogen moved its stock listing. They went from the OTCQX Best Market up to the NYSE American Exchange.
The uplisting.
Exactly. That's fundamental. It gives them much better visibility. And importantly, it opens the door to institutional investors. The big funds that often can't or won't buy OTC stocks.
Right. Visibility helps. But those institutional players, they want to see a solid balance sheet too.
Yeah.
Which I guess brings us to July 2025. What happened then?
Well, they capitalized on that new visibility pretty quickly. They completed an underwritten public offering, raised about $19.9 million gross, which netted them around $18.2 million after costs.
Okay.
And that was absolutely vital. Given their, history of burning through cash operationally, this infusion just immediately strengthened the balance sheet. It gave them the funds they needed, not just for stability, but really for this ambitious new growth plan.
Okay, so fix the balance sheet, more or less.
Yeah.
Got the visibility. But what did they say they were actually going to do with that $18 million? Because it feels like the analysts aren't just excited about more schools and hospitals. There's a bigger shift, right?
That's absolutely the key. That money wasn't just to keep the lights on. It was fuel for the pivot. The pivot into arguably the highest growth energy consumer out there right now, data center.
Data centers. Okay.
Yeah. This is the third and probably the most significant catalyst. Tecogen announced they'd secured a letter of intent and LOI for a massive 100-plus megawatt data center project. And there's even potential talk of expansion later up to maybe 500-plus megawatts. It's huge scale.
Okay, transformational opportunity is what the analysts called it.
Yeah.
But maybe connect the dots for us. Why is a CHP company suddenly a player for giant data centers? How does that tech fit?
Well, it turns out it's a really good technological fit, and it's driven by economics. Data centers, as you know, need vast amounts of power, and it has to be reliable, distributed power. But the other thing is they generate enormous amounts of heat. Cooling them is complex and expensive.
Right.
Tecogen's expertise in CHP lets them offer efficient on-site power, plus they can use absorption chilling technology powered by that waste heat for cooling. This can make their whole energy solution potentially much more economical and also more resilient than just relying on the grid. It sort of moves them up the value chain, you could say.
Okay, so it's a real synergy. And the market started noticing this shift pretty fast. That Q2 2025 report seemed to show it.
It really did. When they reported Q2 numbers, the jump was, well, undeniable. Total revenue hit $7.29 million. That's up 54.3% compared to the same quarter last year.
Wow, okay.
But the really interesting part, the devil in the details, was the product segment. This includes the big equipment sales, the kind you need for these larger projects. That segment saw, and this number's wild, a 2,536.6% year-over-year increase.
2,000%. Okay.
Yeah, it's an extraordinary jump, and it's really the first tangible sign that the uplisting, the capital raise, it's starting to translate into actual large-scale orders. The scaling strategy seems to be kicking in.
That's some serious growth.
Yeah.
Let's maybe shift for a second to their underlying strengths before we hit the financial risks head on. What's Tecogen's competitive advantage, their moat in this distributed energy game?
Well, according to the sources, it's pretty strong. They don't just, sell you the box and walk away. They maintain it. They have their proprietary CHP and cooling tech, yes. But a lot of their stability comes from their service network. And critically, these multi-year service agreements they sign with customers.
Ah, the recurring revenue piece.
Exactly. Highly predictable recurring revenue. And it also creates really significant switching costs. Customers are kind of locked in, which helps stabilize the base business while they chase this bigger data center growth.
Okay. And looking at the finances now, post-offering, market cap around $264.5 million. The key balance sheet takeaway seems to be they've got the cash now, debt levels are low, and they're holding on to that cash, right? No dividend, just reinvesting for growth.
Correct. They're retaining everything to fuel this expansion. And they're running pretty lean, too. Workforce is about, 93 employees?
Yeah, that sounds right.
Which helps keep those fixed costs relatively contained for a company that does manufacturing and service. They're clearly in, maximum growth mode.
Okay, we've painted a pretty positive, forward-looking picture here. Momentum, strategy shift, cash. But let's pause. Let's really challenge this. How do we square that strong buy rating with the fact that, historically, Tecogen has lost money? What were the main red flags in the sources?
Yeah, this is probably the most critical question for any potential investor. Despite that huge Q2 surge, you just can't ignore the past performance entirely. Fiscal 2024 revenue, for instance, was $22.62 million. That was actually down about 10% from 2023. There were industry headwinds, apparently.
Okay, so not all smooth sailing.
Not at all. And more significantly, the net income for the trailing 12 months is still negative. It's sitting at meted $4.24 million. That translates to a negative net margin of about 7.9%. This history of operational cash burn is flagged again and again as the primary company-specific risk.
And even that huge Q2 revenue number came with a catch, didn't it? The margins.
Right, margin pressure. Sales volume exploded, which is great, but the gross margin actually fell. Dropped from 44% down to 33.8%.
Why did that happen? And is that sustainable or a temporary thing?
The sources point to two main things. Mostly non-recurring costs, they hope. First, launching their new hybrid air-cooled chiller product line. That costs money up front. And second, they had to increase staffing manufacturing engineering to actually handle the scaling up needed for these bigger potential projects.
Okay.
So the risk right now is transition risk. Can they get those margins back up towards, the mid-40s where they were, while also executing on something as huge as that data center LOI? That's the balancing act.
Got it. Okay, let's switch gears to timing and technicals. For someone looking at the charts, what's the picture right now, especially given that volatility we mentioned?
Well, as of mid-October, the stock's at 8.92 cents. But look at the 52-week range. 0 alders, 83 cents on the low end, $11.55 on the high end.
Wow, yeah. Big swings.
Huge swings. So that tells you about the volatility right there. Technically, though, the trend is clearly positive right now. The stock's trading comfortably above both its 50-day and its 200-day moving averages. That confirms a defined uptrend is in place.
But that volatility, the market beta is 1.13. That's high. It means the stock's expected to move, 13% more than the market on average?
Yeah, basically. And the sources mention average daily swings of 10% or even more are common. So, yeah, definitely not for the faint of heart, as they say.
No kidding. Requires conviction.
It does. But the analysts seem to have that conviction. They're backing it up with some pretty punchy numbers. The consensus 12-month price target is $15. That implies about 68% potential upside from where it is now?
68% upside potential.
Okay. And some of the bullish trading models we looked at, based on current momentum, they're forecasting a pretty high probability of the stock reaching somewhere between, say, $14.22 and $23.87 by mid-January 2026.
So big potential, big volatility.
What should investors be watching really closely over, say, the next 3 months? What are the immediate catalysts?
The big quantifiable event coming up is the Q3 2025 earnings report that's scheduled for November 11th. The market's going to be looking for strong confirmation of that growth rebound we saw in Q2, strong year-over-year numbers again.
And if they miss? Or if margins are still under pressure?
Then you'd probably expect a pretty sharp pullback given the run-up and the expectations baked in.
Makes sense. And what about the big strategic piece? The data center story.
Right. That's the other key thing to watch. It's all about deploying that $18.2 million effectively. Specifically, everyone wants to see that 100-plus megawatt data center LOI get converted into a firm, definitive contract.
Making it official.
Exactly. That conversion would validate the whole transformational story the bulls are telling. It would significantly de-risk a big chunk of their future revenue projections.
Okay, so let's try and synthesize this. The overall investment case seems, well, overwhelmingly bullish, right? Rated 9 out of 10 in one source. Driven by the uplisting, the cash injection, that strategic pivot to data centers, and the positive technical signals on the chart.
Yep, that sums up the bull case.
But the big buts are that history of negative cash flow from operations and the really high volatility that comes with a high beta stock trying to pull off such a massive expansion.
Absolutely. Success really boils down to execution. Can they convert that LOI? Can they stabilize the gross margins as they scale? If they manage both, the growth potential looks enormous.
So for you listening right now, what does this mean? Is this something you trade short-term, or is it a long-term infrastructure investment?
Well, the sources seem to suggest it could be attractive for both, depending on your style. Short-term traders might look at the upcoming Q3 earnings, maybe play the volatility.
Right.
Long-term investors, though, they're probably focused more on those structural trends, distributed energy, the value of recurring service revenue. They'd be looking past the immediate quarterly noise towards that multi-year growth potential funded by that new balance sheet strength.
But you have to be ready for the bumps along the way.
Definitely. You absolutely have to be prepared for short-term volatility. Know your risk tolerance.
Okay, that's a really thorough look at where Tecogen stands right now. We focused a lot on the internal stuff. The uplisting, the cash, the LOI. But maybe let's leave you, the listener, with one final thought to chew on. Think about the external environment. Tecogen's got a stronger balance sheet now, better market positioning. How might those accelerating tailwinds, demand for clean energy infrastructure, maybe even M&A activity in the space, how could that change Tecogen's path even faster than expected in 2026?
Good question.
And think about policy, too. What kind of specific clean energy mandate or maybe grid reliability rule at the state or federal level? What would really unlock the biggest gains for a distributed energy specialist like Tecogen? Something to think about as you wait for those Q3 numbers.